Welcome back to the Daily Morning Business Feeds on Cove Markets, with me as editor Olivia. Today, let's take a look at some notable business news in the past 24 hours. Thank you for always supporting and accompanying us. Come to the following hot news. Inflation, explained. Why prices keep going up and who's to blame. This was a good week for inflation numbers, but whether it can last is the big question. Inflation, explained. Why prices keep going up and who's to blame. Confused about inflation? You're not alone. Inflation is, paradoxically, both incredibly simple to understand and absurdly complicated. Let's start with the simplest version. Inflation happens when prices broadly go up. That broadly is important. At any given time, the price of goods will fluctuate based on shifting tastes. Someone makes a viral TikTok about Brussels sprouts and suddenly everyone's gotta have them. Boom, sprouts prices go up. Meanwhile, sellers of cauliflower, last season's trendy veg, are practically giving their goods away. Such fluctuations are constant. Inflation, however, occurs when the average price of virtually everything consumers buy goes up. Food, houses, cars, clothes, toys, etc. To afford those necessities, wages have to rise too. It's not always a bad thing. In the United States, for the past 40 years or so, and particularly this century, we've been living in an ideal low and slow level of inflation that comes with a well-oiled consumer-driven economy, with prices going up around 2% a year, if that. Sure, prices on some things, like housing and healthcare, are much higher than they used to be, but other things, like computers and TVs, have become much cheaper, so the average of all the things combined has been relatively stable. Still with me? Alright, let's cut to today, and why inflation is all over the news. When inflation is a bad word. Inflation becomes problematic when that low and slow simmer gets fired up to a boil. That's when you hear economists talk about the economy overheating. For a variety of reasons, largely stemming from the pandemic, the global economy finds itself at a rigorous boil right now. Economists use two main gauges to track inflation in the United States, and while both eased between June and July, they're still near their highest level in 4 decades. The Consumer Price Index for July rose 8.5%. The Personal Consumption Expenditures Price Index, which the Federal Reserve prefers, rose 9.8% in July from the same period a year earlier. And here's where Econ 101 merges a bit with Psych 101. There's a behavioral economics aspect to inflation, where it can become a self-fulfilling prophecy. When prices go up for a long enough period of time, consumers start to anticipate the price increases. You'll buy more goods today if you think they'll cost appreciably more tomorrow. That has the effect of increasing demand, which causes prices to rise even more. And so on. And so on. That's where it can get especially tricky for the Fed, whose main job is to control money supply and keep inflation in check. How'd we get here? Blame the pandemic and Russia's war on Ukraine. In the spring of 2020, as COVID-19 spread, it was like yanking the plug on the global economy. Factories around the world shut down. People stopped eating at restaurants. Airlines grounded flights. Millions of people were laid off as business disappeared practically overnight. The unemployment rate in America shot up to nearly 15% from about 3.5% in February 2020. It was the sharpest economic contraction on record. At the same time, the Fed implemented emergency stimulus measures to keep financial markets from tanking. The central bank slashed interest rates to near zero and began pumping tens of billions of dollars every month into the markets by buying up corporate debt. In doing so, the bank likely prevented a full-on financial meltdown. But keeping those easy money policies in place over the past 20 months has also fueled, you guessed it, inflation. By early summer 2020, demand for consumer goods started to pick back up. Rapidly, Congress and President Joe Biden passed a historic $1.9 trillion stimulus bill in March that made Americans suddenly flush with cash and unemployment assistance. People started shopping again. Demand went from 0 to 100, but supply couldn't bounce back so easily. Turns out that when you pull out the plug on the global economy, you can't just plug it back in and expect it to start humming at the same pace as before. Take cars, for example. Automakers saw the COVID crisis beginning and did what any smart business would do, shut down temporarily to mitigate losses. But not long after the pandemic shut factories down, it also drove up demand for cars as people worried about exposure on public transit and avoided flying. Automakers, and car buyers, had whiplash. Cars require an immense number of parts, from an immense number of different factories all around the world, to be built by highly skilled laborers in other parts of the world. Getting all of those discrete operations back online takes time, and doing so while keeping workers from getting sick takes even more time. Economists often describe inflation as too much money chasing too few goods. That's exactly what happened with cars, and houses, and Peloton bikes, and any number of other goods that became hot-ticket items. How's the supply chain involved in all this? Supply chain bottlenecks, that's another one you see all over, right? Let's go back to the car example. We know that high demand plus limited supply equals prices go up. But high demand plus limited supply plus production delays equals prices go up even more. All modern cars rely on a variety of computer chips to function. But those chips are also used in cell phones, appliances, TVs, laptops and dozens of other items that, as bad luck would have it, were all in high demand at the same time. That's just one example of the disconnect in the global supply chain. Because new cars have been slow to roll in, used car demand shot through the roof, which drove overall inflation higher. In some cases, car owners were able to sell their used cars for more than what they paid for them a year or two prior. What happens next? Prices and wages could be starting to ease, but will likely remain elevated for some time. For how long, and by how much, depends on countless variables across the globe. Russia's invasion of Ukraine dashed hopes that prices would come down significantly in 2022. The conflict has upended commodity and oil markets, driving up prices of food and gasoline around the world. That's compounding supply chain headaches, leading to further shortages of critical food items and oil. Lockdowns in China earlier this summer, meanwhile, left the world's largest seaport essentially at a standstill. Corporations bear some blame as well, as many big companies have been raising prices to protect their profit margins. And there's no telling what kind of new shocks, a resurgent COVID variant, a massive shipping container getting stuck in a waterway, a natural disaster, could set back progress. There's no single government or central bank that can fix the inflation resulting from those global disruptions. But central banks are doing what they can. In the United States, the Fed began raising rates in March by 0.25 percentage point, its first increase since 2018, and have since raised rates 4 times this year. There's no sign that they'll stop anytime soon. When money becomes more expensive to borrow, that can take the heat off price increases and bring the economy back down to that nice, gentle simmer. Or so the Fed hopes. Its biggest challenge is to deploy interest rate hikes at a pace the economy can tolerate. Raising them too much, or too quickly, would risk collapsing demand, which could derail economic growth or even cause a recession. This was a good week for inflation numbers, but whether it can last is the big question. Key points. Import prices fell more than expected and brought some much-needed good news for consumers. That news followed reports earlier in the week that both wholesale and retail price increases abated for the month. Taken together, the numbers are reason for at least a little optimism. But it's probably wise to put exuberance on hold. There was more good news Friday for inflation, as import prices fell more than expected and brought some much-needed relief for consumers. The report capped off a relatively upbeat week for those worried about rising prices, and relatively is the operative word, as the U.S. is on pace this year to import just over $4 trillion of goods and services this year, according to the latest Bureau of Economic Analysis data. With Americans already paying huge bills for food, energy and a host of other items in their daily lives, any respite is a welcome one. After all, the monthly import price drop of 1.4% was just the first this year, and the year-over-year increase is still more than 8.8%. That news followed reports earlier in the week that both wholesale and retail price increases abated for the month. Producer prices declined 0.5%, and consumer prices including food and fuel were flat, both numbers owing largely to a sharp slide in most of the energy complex. People are noticing. A New York Federal Reserve survey released Monday showed consumers are expecting inflation to stay high but not by as much as previous months. On Friday, the University of Michigan Consumer Sentiment Survey, whose ups and downs tend to ride in tandem with prices at the pump, was higher than expected, though still just off record low levels hit in June. This is just one report. Taken together, the numbers are reason for at least a little optimism. But it's probably wise to put exuberance on hold. The Consumer Price Index is still up 8.5% from a year ago, while the Producer Price Index has surged 9.8% during the same period. Krishna Guha, who heads global policy and central bank strategy for Evercore ISI, cautioned in a client note on CPI that, while the report is consistent with the notion that inflation pressures may finally have peaked, this is just one report. Similar comments came Friday from Richmond Federal Reserve President Thomas Barkin. The central bank official told CNBC that the inflation news was very welcome, but added that he didn't see any reason to pull back on the interest rate increases that some economists fear will drag the U.S. into a recession. There is a very long way to go before the Fed will feel it has sufficient compelling evidence that inflation is moderating to stop raising rates, Guha added. The Fed and investors will get a look next week at how much of an impact inflation has made on spending. View from the consumer. The Wednesday advance report from the Commerce Department is expected to show a modest 0.2% headline gain for July in retail sales after a 1% increase in June, according to FactSet. The report is not adjusted for inflation. However, there is a wide range of opinion on where the numbers could land. Citigroup said its credit card data show a potential 1.1% decline for the month, while Bank of America said it sees a 0.2% decrease, though control group spending, excluding a variety of volatile categories, may have risen 0.9%. Fed officials will be watching closely to see larger trends in how inflation is impacting Main Street. It does appear that a tentative peak in inflation is in place, said Joseph Brasuelas, chief economist at RSM. However, he said this week's numbers are likely to do little to sway a Fed intent on stomping inflation down to the central bank's 2% target. I think that the July inflation does nothing to alter the path of Fed policy, and any notion that a Fed pivot is at hand should be dismissed, he said. We are some months away from any potential clear and convincing evidence that inflation is well on its way back to the 2% target that currently defines price stability. And those are also the most outstanding news that closes daily feeds. Thank you to everyone for listening and following Cove Market channel. If you find the video interesting and useful, please click like and subscribe to our channel so you don't miss any of the latest business news.